Welcome to Money Talks America. I'm Shawn, Snaith, Director of the Institute for Economic Competitiveness in the College of Business Administration at the University of Central Florida, and your host for Money Talks America. Today, a special roundtable discussion of the economy and the results of a just-released outlook survey by NABE, the National Association for Business Economics. Joining me today is Lynn Reaser. Lynn is a former economist in the banking industry and currently chairs the NABE Outlook Survey Committee and is the vice president of NABE. To my left is Shawn Dubravac, an economist with the Consumer Electronics Association. Shawn directs CEA's Economic Analysis Group, including evaluating and fulfilling the research needs of the organization and helping to define the strategic direction of the association. Welcome to you both. The May 2009 NABE Outlook presents the consensus of macroeconomic forecasts made by a panel of 45 forecasters. The survey covering the outlook for 2009 and 2010 was taken during the period covering April 27th through May 11th. The NABE forecast expects a further decline in economic activity in the second quarter, making for the most severe economic contraction in over half a century. Real GDP is expected to fall at 1.8% rate during the second quarter of 2009. Pretty dismal until you look beyond that period. Then we see the results of the survey indicating that the preponderance of the panel members believe we're going to be pulling out of recession in the second half of the year. Lynn, do you think that's an accurate perception?
It is. In fact, most of our people believe that we will see the end of the recession in the third quarter. Few people think it could come in the fourth quarter, the rest in the first quarter of 2010. But none of our panelists believe that this recession will last beyond the first quarter of 2010. So we are close to the end of a very deep downturn, although it's likely to be a fairly weak recovery and the unemployment rate will still move higher.
We're going to touch on the unemployment rate and labor markets in just a minute. But Shawn, in terms of the recovery, you've heard a lot of discussion in the media about a V-shaped recession and recovery, or a U-shaped recession and recovery, and sometimes a W-shaped recession and recovery. What is the shape of this recovery?
Well, I think, before we jump into that, it's important to recognize that this has been a very long and severe recession compared to everything we've seen in the post-World War II period. The average recession in the post-World War II period is 10 or 11 months. This will surely be the longest recession we've had in the post-World War II period. Most recessions tend to recover pretty quickly and look very much like a V-shaped recovery. So I think the consensus now, and certainly this forecast bears that out, that we're expecting a slower recovery coming out of this recession. I would argue that's quite atypical of what we've seen in some of the past recessions, where things tend to bounce back relatively quickly.
And that typically is the case. When you have a deep downturn, you have this sharp upturn. We're looking at a recovery, but it is going to be subpar. And why is that? One, it looks like the employment recovery will be fairly anemic. Companies just aren't going to be ramping up their payrolls. Second, consumers have seen their net worth hammered by the declines in the stock market and the housing market. And then third, credit conditions are still fairly tight. So all those three factors are likely to keep this recovery from being weaker than you would typically see following this deep downturn that Shawn's been talking about.
Right, and I think typically when we come out of a recession, it's the interest rate sensitive industries that are pulling us out of a recession. It's housing, it's banking. Banking, of course, does very well in a high where you have a high yield spread, and they can borrow really cheaply and lend long at much more attractive rates. This downturn's been much different because it's these interest rate sensitive industries that actually brought us into recession, or at least helped prolong the recession. Housing, of course, having a big impact there. And so typically where housing might help us come out of a recession, they're not this time in a position to really help pull us out of a recession.
I mean, the usual suspects are not present, I think, in this particular recovery, and so the consensus in the Outlook survey is that it's going to be a gradual climb out of a pretty deep hole. Now, we've touched on a variety of subjects I think that we need to explore a little bit more thoroughly, But let's talk about the financial sector, and let's talk about financial markets and the profound nature of this credit crisis and what it's going to take. How long is it going to take until we get out of this? Lynn, have you ever seen anything as profound as what's happened in financial markets in this recession?
This has been a traumatic recession because of the crisis in the financial markets, and it's been a worldwide phenomenon, and it's going to take a while for us to unwind the excessive debt that we've seen assumed.
Sorry to interrupt. I saw a figure actually that 66% of the world's economies are in recession at the same time, which is the highest figure since the Great Depression, when that number was around 80%. So you're absolutely right that it is a global phenomenon. But I didn't mean to interrupt your train of thought. How is this sector going to right itself?
Well, we are seeing some signs of improvement. The Federal Reserve and the Treasury have implemented a number of programs. Our economists, in fact, were asked whether or not the Federal Reserve's various programs are working to help alleviate credit markets, and most of our people believe that they are, in fact, being successful. Still, the view of our economists is that companies are still having some difficulty in securing credit both in the short and for long-term financing. So we're not totally out of the woods. Credit is still going to be tight. Credit-worthy consumers and businesses still get loans, but it is definitely going to be a tighter situation over the next couple of years.
So, I mean, the Fed and the Treasury to some extent have taken historic action to address this credit crisis, and they've had to operate on multiple fronts because it started in housing finance, but that sclerosis spread across virtually all types of credit, and I think that's why it was so profound and ultimately what plunged us into the deepest part of this recession. Have they done enough? Is there more that has to be done in terms of the policy side, or have the actions of the Fed and the Treasury to date been sufficient to finally right this credit ship?
Well, we are certainly seeing unprecedented times in our economic history, but we're also seeing unprecedented steps towards responding to that. I'm often asked, are we going to see a lost decade like we saw in Japan? And my response has always been, the U.S. this period will make their own mistakes. We're not going to make the mistakes that have been made by others. We're going to figure out our own new mistakes. This, for example, is the first time the Fed has ever targeted specific yields within specific markets. Typically, monetary policy was enacted through open market operations, and they let the private sector figure out where that capital would flow to. So, this round we're seeing things that we've really never seen before. We've never seen the Fed go at yields within very specific sectors of the financial markets. The other important thing to note is that all of these things take time to develop and to mature. So it's taken a while for these spreads to come in as the Fed has targeted them. It'll take a while for some of the externalities to appear as well. We don't know what all the externalities will look like, so it's very difficult at this point to decide if things have truly been successful or not.
I think the reality is that the cure to this disease is going to have some side effects of its own, which we'll have to deal with at a later date. But I mean, the treatment of the economy has been like a trauma ER room. I mean, because there's multiple injuries that had to be addressed simultaneously. These were not contained crises in one sector of the economy. And you mentioned Japan's last decade. It took Japan almost 6 years, I believe, to finally ratchet short-term interest rates down to zero. The Fed did it in 6 months. So, I think those comparisons are falling by the wayside very, very rapidly.
And there really are two different models that can be used. One is when we used during the S&L crisis previously in our own economy, where we basically moved all these bad assets off the S&L balance sheets. And the other situation was one with Japan, where they basically let these bad assets just stay on bank balance sheets for a number of years, which somewhat strangled the economy. So that is why, to answer your question, what needs to happen next, we need to now move some of these bad assets off bank balance sheets, hoping to sell them to investors so that we will have banks able to lend more freely to businesses and consumers.
Right.
And I think that's been part of the rationale behind targeting some of these bad assets is to learn from what we learned and apply what we learned from the Japan lost decade and try to move some of these bad assets off the banks so that they can get back to a lending environment. And certainly, where the yield curve is now is an attractive place for for banks and financial institutions.
Well, we want to talk about the yield curve in just a second because we've got some fiscal policy in place that may have an impact on the shape of that yield curve in terms of long-term interest rates. Let's go back to TARP in its current incarnation. It's been a little bit of a bipolar policy here because it swung from one thing, buying these toxic assets, to direct capital injections, to now back to buying these assets in some sort of public-private partnership initiative. I mean, one of the problems, I think, is a political one. The market effectively said these things are worth nothing because that market dried up. Nobody wanted to buy them. And here comes the government. They're going to pay tens, hundreds of billions of dollars for what the market said were worthless securities. And there's a political hot potato there. I mean, is that something that the administration is just going to have to grin and bear to finally get through this?
Well, the original purpose, as you suggested, of TARP was to buy these toxic assets and take them off bank balance sheets. But then it was determined that that might take too long, so they shifted priorities and decided instead to use the TARP money to put more capital into banks, basically to address the right-hand side of the balance sheets. Now they are moving back to that first purpose, trying to move this money, these bad assets, off bank balance sheets, addressing the left-hand side of the balance sheet. But there's not much money left in TARP, and Congress and the public have no appetite to giving any more money to do that. So what they're going to try to do through these public-private partnerships is to try to induce private investors to buy these assets from banks. But it's not clear how successful that program will be, whether banks in fact will sell at perhaps losing prices and investors will buy with perhaps federal strings attached. So that is critical to what needs to happen. It's not clear that it will.
It's going to take two sides to tango here, and I think the government's going to be dancing with some interesting partners,
and not a lot
hedge funds,
and not a lot of money to induce them.
Exactly. Shawn, let's talk a little bit about the consumer. We were chatting before we came on the air here about a new age of austerity. The old U.S. consumer had 5 credit cards, all charged to the max. When they went to buy a home, he or she bought the biggest home they could afford a payment to purchase. That's changed somewhat. We've seen a negative savings rate go to a positive savings rate. Is savings here to stay? Is it now cool to be a saver in America?
Yeah, I think certainly the panel and the results of the survey bear that out, that the consumer savings rate, in other words, the not spending rate, is increasing and probably likely to stay, at least in the near term. It often takes these incredible shocks to change consumer behavior. We saw it finally happen last year when gas prices breached $4. For the first time, consumers really cut back in the amount of gas that they were purchasing, and they changed their behavior. They started commuting together, they started taking public transportation together, they'd run errands at the same time as opposed to one-offs, and tried to bring in the amount of gas that they were consuming as they finally adjusted their behavior to higher prices. I think you're seeing the consumer go through that same process now when it comes to general spending and savings. They're cutting their spending. Certainly discretionary spending is always cut back during a recession, and that's exactly what we're seeing now. Consumers cutting back on those things that they think they can defer. So durable goods, anything that can last just a little bit longer. Can I get another year out of my washer? Can I get another year out of my car? Those purchases have been delayed. Whether this is here to stay, I think, is something that will materialize after the recession. How long will consumers in the future let that washer or dryer last? How long will they let that car last? Right now, there's and autos, I think, is a great example. There's a huge disconnect. The average car before the recession was lasting on average 9 or 10 years. If you take the installed base of cars and you divide it by annual sales, you get something like 26 years now. So the market is now telling us that cars are supposed to last 26 years. It went from 9 or 10 years to 26 years overnight practically. So we do expect some of this pent-up demand to be fulfilled. As we work our way out of the recession, consumers are going to go back to buying cars. They're going to go back to buying washers and dryers. The big question is, at what rate?
And are these changes permanent? I mean, certainly in the short run, savings rates have jumped up, but we've all seen our 401ks transformed into 201ks or 101ks, depending on your allocation. If we see a recovery in financial markets and those balances start to go up, are we going back to our old ways?
Well, that's a very important question, because the children of the Depression were somewhat traumatized, and you saw for a long time a much more frugal pattern of behavior.
For a lifetime.
Right. So the question is, today's Americans, have they been so traumatized by the drop in home prices, stock prices, that they are going to continue to save at a much higher rate? Or with an economic recovery, a stock market rebound, are they going to feel more confidence to start to replace the washer and dryer, go out and buy the car? We asked our members, and about 70% of them say that Americans for the next 5 years will be more frugal, that they will be more conservative in their spending patterns. There's still, a fair number of economists say no, they'll go back, but at this point, the majority of our panelists believe that there has been somewhat, at least for the intermediate future, a cultural shift of American spending.
And I think what the American consumer realized as they went into this recession is that they were much more risk averse than they thought. When they saw huge declines in net worth, both from housing and from equity declines, they realized that they were probably a little bit more risk averse than they originally projected. And so they're adjusting that risk aversion. I think that's part of what's helping drive the savings rate up as well, as they realize it's worth having some position in cash and saving some of that and not just consuming every last dollar.
Which could be a good thing for the American imbalance, the imbalances in the world economy, to the extent that the overall U.S. economy has not been saving enough. We have consumers who have not been saving anything. We still have the government problem, though, where the government is definitely not helping our saving picture.
Let's talk about that 800-pound gorilla. We haven't been saving, that's right, but fortunately the rest of the world's been lending. And they've been lending in record amounts, particularly to the federal government. We're in a situation where we're running, now I believe the estimate's a $1.8 trillion deficit in a year. And that's hard to get your head around. Yeah, that's a lot of money. Will the rest of the world continue to buy Treasuries in sufficient quantities to keep interest rates low? Or will we see a return to the crowding out of the 1980s?
Well, this is a very important question. Our panelists think the overall federal budget deficit will be about $1.7 trillion this year, and still $1.4 trillion in fiscal year 2010 when we're looking for a recovery. And at this point, there is definitely a question about the impact of the dollar. And so our panelists actually believe the dollar will experience some decline. But as you mentioned earlier, the Federal Reserve has now been buying long-term Treasury yields to try to hold down any potential pressure on long-term interest rates, including mortgage rates. But our panelists suggest that that's not going to be enough, that long-term rates are going to go higher, dollar is going to go somewhat lower, and there is this risk of whether or not we will receive as much support from the rest of the world as we've seen recently.
And I think that the other issue there is, well, interest rates are going to continue to move up, and our panel expects, the 10-year yield to get close to 4% by 2010. It's not going as high as one might suspect with the amount of debt that the government is going to have to issue to cover this imbalance. So I think that continues to be a big issue, is are we setting ourselves up for hyperinflation in years to come? That isn't, I think, being borne out in the survey results. It's not being borne out in some of the market indicators that we look at. But yet, I think the issue still remains.
No, people seem to be worried about inflation, but if you look at our survey of economists. They think inflation is going to be very low for the near term. We have a lot of excess capacity. Workers don't have any bargaining power, so that even by the end of next year, inflation overall is going to be less than around 2%. So it's going to be quite moderate in the near term. But I do believe that the Federal Reserve cannot continue to supply all this liquidity. And in fact, our panelists believe the Federal Reserve will be starting next spring to gradually raise interest rates.
They're definitely going to have to move to absorb some of this liquidity. I mean, the balance sheet has grown phenomenally, and therefore the money supply has shot up dramatically. Let's talk about what the panelists said. You know, the Fed, they believe, is going to begin to tighten in the mid part of 2010.
Spring of 2010.
But that's the median. There is some disagreement that the Fed might actually have to start doing things sooner. With an eye on the long run and an eye on price stability, what's the likelihood that the Fed may start to raise interest rates by the end of this year?
I think there's definitely some possibility there. I think the question is, do they have to change some of their other behavior if they raise interest rates? They're in a new environment where they can now pay interest on excess reserves. So are they in an environment where they can continue to raise their target rate for the federal funds, but at the same time not have to absorb as much liquidity, or at least immediately absorb this liquidity? I think this new environment might give them some flexibility that they haven't had in the past to raise interest rates while still having a lot of liquidity out there.
I think there's less disagreement about when the Federal Reserve will raise interest rates than how much in 2010. I think generally the view is that this will be a slow starting recovery. It's possible the Federal Reserve might have to move in the next 6 months, but generally I think the Federal Reserve will be inclined to be cautious because this job market won't turn around overnight. We, as a panel, believe the unemployment rate's going to reach 9.8%, nearly 10% by the end of the year. It'll stay at that level in the first quarter of next year and only be down around 9.3%, 9.25% by the end of next year. So it's going to be difficult for the Federal Reserve to be very aggressive, particularly since it will not be clear that the economy really is in a full recovery early.
Well, let's talk about the labor market since we brought that up again. I mean, this is going to be the ugly scar that remains, I think, on the economy after we've come out of this recession. The Outlook panel suggests it's going to peak out around 9.8%, but be very slow to come back down from those levels. Again, there's a range. Some of the panelists were over 10.5%, some a little bit lower. But there's no doubt that the labor market's been profoundly impacted here, and that, at least in recent cycles, it has responded with a significant lag to improvements in the economy. The last recession recovery, the recovery was dubbed the Jobless Recovery. Is this going to be another jobless recovery? If so, what does that mean for consumers? What does that mean for the economy?
I think that's definitely, what the survey bears out. Unemployment now is, right under 9%. The survey expects it to continue to rise throughout 2009, and ultimately it's higher in 2010 than it is now. So clearly, as the economy starts to recover, unemployment remains high. Part of that is not too surprising. That's what we expect. The labor market always lags in economic recovery, and typically isn't bottoming out until 6 to 12 months later after the economy has bottomed out. So part of it, we expect that, and so it's not too much of a surprise. I think the key issue is how long until we get back to the unemployment levels that we saw headed into this recession. And I think indications are that it could take several years before we actually get back to the unemployment levels that we saw as we went into this recession last year.
Our panelists do believe that the job losses are going to start to diminish to some extent. They'll probably continue through the end of the year, but they'll be smaller than the 600,000 we've been seeing month after month for the recent times. And then next year, we should start to see some job gains. But they won't keep up with the number of people that are coming into the workforce looking for work. So that's why the unemployment rate is going to stay high for quite a while.
I mean, I think there's a sense that we're in a transition period or a period of inflection where 3 or 4 months ago it seemed like we were falling into this bottomless black pit, at an ever faster rate. But recently the data has indicated that we're still going down and we're still in recession, but the parachute's been deployed and
Right.
the rate of descent has slowed, and that I think has prompted a lot of this talk about green shoots and so forth.
And exactly, and one of the key depressants on the economy, of course, had been housing. That was the root of all the problems to begin with. And our panelists believe that we're likely to see nationally home sales and new housing starts hit their low point by the middle of this year. It's likely to take somewhat longer for home prices to bottom out, but generally our panelists are more split on that view, but they think over the next 2 to 3 quarters, even home prices nationally are likely to finally bottom out. It's going to take longer here in Florida, but at least nationally, the housing market is close to its low point in terms of some of its primary.
Well, you mentioned Florida. We hope you'll both buy a condo before you get on the plane today. But we've seen prices in this state, and I'm sure it's true in some of the other ground zeros of the housing implosion, prices that have fallen below replacement cost. I mean, that's a natural long-run bottom for housing prices. So we've overshot maybe on the way down. But how quickly can we pick back up? Starts have been suppressed dramatically throughout the country, but it also kind of goes back to credit markets again. Can worthy borrowers get loans? Right now we're seeing a lot of the first-time buyers getting FHA funding, taking advantage of the tax credit, but that still precludes a lot of other people that in normal times would be reasonable risks and would get a mortgage.
And I think it goes even more, further beyond just availability of credit and its desire for credit. That's one of the things we've seen change with the consumer. Part of it is that they can't get access to credit, and the other part is that they don't want the credit. They don't want to take on the additional burden, whether it's to buy a house, to buy a car, or to buy some other good. So I think that's something that we're looking at now. I think 6 months ago, if you looked at the forecast, there was still a lot of uncertainty, and there was very little visibility into the future. That made consumers very hesitant generally, whether they were buying a home or buying something else, very hesitant to commit to anything in the future. Even if they felt like their job was secure, their net worth was hit, they still had net worth, they still owned their home, they were above water, if you will. They were still very hesitant because they didn't know what the future held. I think now we're getting a better visibility at what the bottom looks like, when it's going to happen, and that we will eventually move out of this.
And the housing market is showing some positive signs. We've seen affordability improve dramatically with home prices coming down, mortgage rates below 5%. We've seen a boom in refinancing, just an absolute boom. So that's helping a lot of existing homeowners. And if people can document their income, they can put up a down payment, they can get financing, and we're seeing a lot of first-time buyers who had been priced totally out of the Florida market. They're now coming in and helping to absorb some of these foreclosed properties.
Affordability is the silver lining, I guess,
it is
of
the
all the
silver
home
lining.
equity that we've lost. Lynn,
The market's overshot on one side, now they're overshooting on the other side. We'll get back to normal at some point.
Well, I can't wait for those days, but I think between here and normal, there's going to be a lot of things to discuss. Lynn and Shawn, I'd like to thank you for joining us today on Money Talks America, and we'll see you here next time.